Hey guys, how you doing? Robert with Iconic Traders here. We got Jack Leeson.
What's up, guys? How's it going? Today it is November 1st. I haven't put my Halloween decorations away. So we are joined by a special guest, the Pennywise Clown, and he's going to be helping Robert and I actually go over something you probably have heard of but don't know all the information about. We did a little bit of history and research into the pattern day trading rule. When was it created? Why is it created? And how to get around it. So, Robert, take it from there.
Definitely. Yeah, we're going to be going through some interesting things. Now, I personally started trading and, I was doing all this research. I was super interested. And then all of a sudden, boom, I read about the PDT rule. I'm like, what the heck is this? And basically the PDT rule is kind of like a nanny type, mommy rule, I guess, so to speak, from the SEC, that you have to have $25,000 or more in an account to trade freely, meaning to trade more than 3 day trades a week or 5 rolling business days, right? Or trading days. So to summarize again, if you have less than 25,000, you can only day trade 3 times a week. So buy and sell within the same day. And so I was kind of alluding to earlier, I got started and I had to deal with it, and we'll kind of go through it, how I dealt with it trading as well.
Yeah, so guys, pattern day trading rule. I remember, you open your first account. I was 18 years old when I opened my first account. I'm a freshman in college. I don't have $25,000. Let's face it. If I had 25 grand when I was 18 years old, I might have not even went to college, because at the time I thought that was a ton of money. But I didn't understand until my account was suspended that if you take more than 3 intraday trades, that means buying, at the New York Open or right after it and then closing it the same day, that you cannot do that more than 3 times in a 5-day rolling period. So that doesn't mean 3 times in a week. It's a 5-day rolling period, because say Thursday I take a day trade, Friday I take a day trade. That doesn't reset Monday. If I take another day trade Monday, boom, that's 3. You can't take more than 3 day trades. Your account will get flagged. Your account will get suspended. First time, if you ever been flagged by the pattern day trading rule, usually the brokers will kind of let it slide. They'll be like, okay, don't do it again. As soon as you do it again, your account's suspended, usually for 90 days, which means no trading for 90 days. And there's nothing more discouraging when you're learning how to trade, the fact that you don't even have an account to trade. You can either open up another brokerage account and wait till they suspend you, but this is such what I consider mostly an archaic rule. We can go into Robert's got the history on when this rule was actually written, so you can follow up with that.
Yeah, I was surprised, just like you, that it was actually started more recent, which was 2001. I thought it was something from a long time ago. So I guess the SEC decided that that day trading is super risky and that they need to protect people from themselves. Again, nanny rule, as I was saying earlier, which I'm not a fan of, and that people with less than 25,000 are a higher risk or less sophisticated trader, and that's just not the case. And so it can be an issue, and we'll go through that. So
we can talk about the history. If you guys think about, so this rule was implemented February 27th, 2001 by the SEC. And if you think about what were the markets doing in 2001, we're coming out of the 90s bull market tech run where everybody was really making money, whether they knew how to trade or not. It was the first time that the retail trader got super involved actively with a bull market. You're talking everybody. I met a guy in college who was 40 years old, by the way, and he had made $1 million out of 10 grand. And he knew nothing about stocks. I mean, this guy was 40 at the time, now living in his parents' basement. However, he had made $1 million in the stock market. So it's a totally different market than any of us have ever traded. Everybody's coming off a hot streak. All of a sudden, 2001 comes around. People start losing money. The market starts going down. Then the SEC decides that it's a good idea to put this rule in, which you actually think had a negative impact on people able to get out of positions. Because if you're trading, you can't even take a loss. It doesn't even matter if you're winning on the trade. If you're losing on a day trade, you have to close a position, or you want to close a position, you can't with the pattern day trade rule if you're already taking 3 trades. So it's interesting to think about the timing with the history of the market and when they implemented this rule. And it's critical to think of as traders and how really archaic this rule now is as it applies today. Part of the reasons they implement it was because they had extremely excessive commission costs back in the day. People still calling in phone orders, $50 a pop to talk to your broker. Of course, they don't want people, making 4 or 5 phone calls a day. Next thing you're $200 down the drain in commissions on a single day just from picking up the phone and placing orders, which is crazy. And now we have things like Robinhood and now even TD Ameritrade, E-Trade, all of these platforms, they have free commissions now, right? They have free commissions. So, what's the point of this rule? So,
yeah, I've been seeing petitions around on the internet, like whitehousepetition.gov or whatever to get rid of it. Got to get 100,000. It's not getting there. But yeah, it is, even though it was relatively recent in 2001, it's certainly an archaic rule for our current market environment, especially with the thing trades. You want to be able to trade freely. In my experience, I've done a mixture of swing trading and day trading. So I'll tell you that I like the flexibility of being all at cash at night and sleeping easy and not being forced to swing trade. And that's kind of what the PDT rule can do to a trader if they're they have 3 day trades, right? So you're going to always want to keep those day trades in your pocket. So if you're in a position, you're going to potentially hold it longer than you should, just so you can swing it overnight. And if you do swing it overnight into the next day, of course, it's not a day trade. So you don't get a knock against you, right? So you'll still have that day trade. And that may be good or may be bad. Generally, you want to trade what you see and not hold the stock for some other reason besides what you're looking at, besides the price action, the volume, and things like that. So, and also psychologically, it's an issue. You don't want to be counting your trades. I was there, and sometimes I had this little piece of paper, right on my monitor at all times with a little dash for the week or whatever, and the date of when my day trade was. And so I'm looking at this thing just to make sure, and there's a lot of things with the market that you have to digest and think about, and you just don't want to be counting your trades and being limited in that way.
Yeah, if you also think, I remember back to when I first started into trading, I had no idea what risk management was. So especially when it comes to if I can only take 3 trades a week and I have a small day trade account, right? So I'll call 2 or 3 grand. I'm going to go all in on every trade, right? Because at the time, I first started day trading in 2008. I was a flat rate commission fee. So I was always thinking, well, if I'm going to put $2,000 on a trade, that's going to be a lower percentage of costs the more money I put in, because it was a flat rate. Now it's different with very low structured commission fees back then, but that at the time, being an uneducated trader, which most people when they first start trading fall right in that criteria, made me want to go all in every single trade, because I knew I'm trading a stock. I can only take 3 of these trades this week, so I might as well make the most out of without any idea of risk control. So I really think once again, it forces people into bad behavioral habits. No hard stops, which you mentioned. You're not going to put a stop on your trade because you have to be very selective if you want to get out or not. But why can it be good, Rob? I don't want to just hate on the PDT. Obviously, yeah. Hopefully these guys are smart that wrote this law. There has to be some reasons as to how it could positively affect either newer traders' performance. So tell me what you think are the positive things that are going on here, Rob.
Yeah, so like I said, I dealt with the PDT when I started and I got out of it. And I will say that it does force you to be selective. And if you are starting with a small account, which even if someone is new and they have over 25,000, it is good to start small, get used to risk management, things like that, and being, like I said earlier, selective. You want to be more selective than others when you're trying to grow an account. And that's the number one thing I would say to advise people trying to grow an account is to be selective. You may be in a community like ours, Iconic Traders. You may be seeing others trading more frequently, but you don't know where they are in their path. So if you are starting out, being selective and it's important, and this kind of forces you to do that. And then I would say, well, I guess now there's some low commission solutions, but there's certainly some others that I recommend that may have commissions that you trade less, you have lower commissions, which is a good thing as well.
Mhm. I think like the biggest thing to take away, like although like technology's evolved with the commissions, is just the thought and whatever trader needs to take into consideration when they first begin is to, if you only have three options, like really develop a process around those options. Don't go in gunslinging. Their intention here for the SEC when they wrote this rule was to help, your average retail day trader. And with that being their intention, you have to focus on their intention and what can be good out of this. And guys, that's really developing a process, understanding. It's just really too easy for people to open up a trading account and just start flinging away. Especially if like younger kids, when you get excited, you see it on the internet, people making money. I was definitely one of these people, and you're like, I'm just gonna start trading, right? And then you come to realize that there's probably a lot more I need to learn. So make sure that you are following the process. The intent here is to prevent over trading, which I know is a big mistake that newer traders make. They're just taking everything that comes their way. Stocks going up, they're chasing it. You really want to be developing a game plan with that. So couple of interesting things about like the pattern day trading rule as far as what it affects. So pattern day trading rule affects stock trading and options trading, but there's a couple of ways that people have used to avoid that rule. And Rob, if you want to talk about like specifically with stocks, how people have avoided the pattern day trading rule if they don't have $25,000 in their account.
Sure. There are some offshore broker solutions that you can find, use, and trade with. I'm not going to get into specific recommendations. I will actually tease something for you that we're actually working with very soon here, a American US solution where you don't have to, go to another country, with your money. So just stay tuned for that. I can't reveal too much right now, but there are options out there for you if you're urgent right now. If not, we're going to have a really, really positive US-based solution for you where you can trade freely and focus on things, and you'll have people to help you and manage risks and things like that. So again, yeah, there are options out there for you now. So
what are the options? When you say they're options, like that's a little vague. I think your average person, like, what are they? Like, what we want to be careful of is not recommending any of these individual brokers, and that's why Rob's like tiptoeing this line here, guys. Just so we're not trying to like keep every information. Obviously, for us to recommend a broker, you always want to do your individual research. Like, I don't have one of these brokers that Rob's talking about. I'm not actually sure if he does, but there are things that are kind of they're just I want to just say there are ways around the rules, and we don't want to recommend that exactly because they're basically avoiding security laws, and we don't want to be involved with the promotion of avoiding security laws. But you can find out those individual names online. I don't think there's like really anything individually illegally about using them, so it's not like you're going to prison. Like, it's not totally illegal. It's just really a loophole, right?
Right. Yeah. Definitely. And there's a lot of things there to look at. You can research.
Yeah. And then, okay, let's move into, so products that you can actually, like, if you don't want to trade stocks or want to look at something else, it's kind of interesting when they passed these laws and regulations in early 2000s, they did not pass them for Forex. So they don't apply to Forex and they don't apply to futures. I myself am a futures trader. And I traded stocks. I went through like a whole progression of trading. I traded stocks, I traded options, and I found out what futures are. I'm like, oh, let me trade these. And now that's what I do to this day. But futures typically are considered like a more sophisticated product to trade. Like, you don't meet somebody who trades futures that like just got into trading, like, I can't tell you how many people I've met that say, oh, I just started trading. It's like, what are you trading? Like, they're most likely trading stocks. Maybe Forex. Forex is getting a little bigger on the new age circuit because you don't have to have the pattern day trading rule. But the reason these products weren't included in these rules is because they were considered to only be like only sophisticated investors even knew what futures were or even knew what Forex was. But as the platforms and like social media especially has brought all of this trading to the forefront. I mean, you see like Forex traders on Instagram going, hey, DM me for signals. Well,
It's flipped.
this didn't exist, right? This didn't exist in 2001. So, just going back, I mean, this, just like any other market, the market has evolved. This rule needs to be changed. Rob, if you find that petition at whitehouse.gov to change, we're going to get it out.
You know what? If I'm try to find it, and I'll put it in the description below. And if I believe if you get 100,000 signatures, then the White House has to respond to it. Last I saw, it was about, I think, 10,000. But I don't know if
we
it's a
can get the
timeline.
waves going. Let's see if we can get 100. Share this video. We're going to put the link at the bottom. Share this video. Get your friends to sign up. We don't want people to be subjected to this rule any longer. There's been a lot of technological advancements that have been really beneficial to your average trader. And I think it's more and more important for people at younger ages to get involved in trading, or at least be interested in investing with products like Robinhood, free commissions on TD Ameritrade, E-Trade, and all of those other platforms, and as well as what Rob's got coming.
Yeah, and I think the point is that everyone wants to know, oh, what's the best of this or that? And that's just not the case. It's not how it works. There's plenty of solutions out there. You just got to do your research and what you're comfortable with. It's really more about your trading style, your strategies that you learned, your risk management, things like that, and your psychology working to become a trader. The tools and all of that, are a little bit not as important, especially in the beginning. And we just wanted to bring to you attention to the PDT rule and some strategies to deal with it, like being selective on your trading, things like that, and some good and bad of it. So, hey guys, we have a free watch list. It's totally free. And literally 2 weeks ago, this watch list was posted on Sunday night before the Monday Open, or maybe 3 weeks, sorry. And there was a 500% gainer on it. There's always something on this watch list that moves generally the next day. We do it every week on Sunday to prepare you for the week. A lot of these stocks, you want to pay attention to them for several days. Sometimes these moves happen right away on them. Sometimes they don't. But, we'll break this discussion on the price levels and everything. So you can sign up below to our free watch list, and we'll email you every Sunday the best stocks to look at so you're ready to go and start the week off right.
So for those of you guys who are already trading and you don't have the time to do the homework, or just want somebody else's opinion, definitely recommend that. I'm on it. I subscribe to it. So I don't even, not a huge trader of stocks, but if I see a hot one on there
you go.
I'll grab it.
All right, cool. Well, we'll say goodbye to Pennywise and you, Jack. We'll see you in the next one.
See you later from Chicago. Take care.
Bye-bye.